All right, welcome back to another episode of Can an Income Portfolio Sustain an Early Retirement? For those of you who join us for the first time, me and my wife decided to early retire back in 2024, and then we've been living off our income portfolio ever since. This series is to track our progress. So basically, I track all of my withdrawal and all the growth for my income portfolio, and then I compare it with other hypothetical portfolios with the popular ticker such as VFV, XEQT, HYLD, and recently I added QQC to see how the strategy would have performed if I were to early retire off other popular portfolio ticker and strategy. So without further ado, let's get into the number. All right. So so basically I track it from basically mid-January to mid-February. So far, the month hasn't been very strong. The portfolio did dip quite a bit from last month, but again, it has happened across the board. Um, a portfolio is generally very tech heavy. As you may know, here we have a concentration in a lot of tech here. YTSL, which is Tesla, QQQY, which is basically a very tech focused, and JEPQ, of course, a very NASDAQ, which is also tech heavy. So for those of you who joined for the first time, I divided my portfolio into three parts. We have the core holding, which is generally all under the register account. These are basically for the longer term growth. So you can see there's a VFV, which is a little bit more catered toward the growth, doesn't have a lot of dividends and distribution. Everything from this portfolio, you can see the total amount here along with the distribution estimate. Everything here is supposed to be reinvested into the portfolio for a long-term focused mindset. And then we have the margin account. This is basically the margin part. This one is going to be a slightly more active part of the whole portfolio. This part is going to be changing quite a bit more. We do use a leverage, like a moderate margin for this part of the portfolio. I do sell option here and there to kind of boost the return a little bit. So the idea is not to try to hit a home run, right? The idea of this portfolio is to generate maybe using margin to generate extra 1 or 2% of the whole portfolio per year. That is a goal, just to kind of up the return by slightly. Um, so far, we haven't do much change here. I did sell out of YMAG, which I gave a good rant last video about why I sold out of it, and then I bought into QQY instead. So far, the sellout seems to be a good decision. I'll explain a little bit after why I decided to sell out of it. During the big dip the past month, these portion portfolio, which is the fixed income part, performed really well. The idea of these one is to be slightly up. I see a good opportunity on these about 2 years, 3 years ago, and bought into them when the interests were very high. So far, I have done really well. They appreciate quite nicely due to interest rate becoming lower, and then the COVID fears start to fade away. For those of you not aware, these preferred shares are mainly from the Brookfield office, Brookfield Property Partner, which own a lot of real estate in like a major core city area. During that time, interest rate was at like a multi-year high. So how fixed income works is that when interest rates go up, the price of it goes down, and then the distribution rate also goes up. So I saw that the rate was really high, so I decided to buy into these at the very depressed price. At the time, they were paying like 12, 14% dividend per, and then they also eligible dividends as well. So far, this had worked really well. So that's the idea of this margin account is to try to see those opportunity and then try to jump into them. Right now we are taking out margin about 38,000. It's a little bit hard to track because technically the margin balance is a lot lower, but then I sold a lot of long date puts, and then it does affect the total amount of the account. But then the margin balance is very hard to track because the how put option works is that you get the money up front, but the value of the contracts fluctuates. Okay, so then the third part of the portfolio is the living expense portion. So this part is very geared toward an income. So everything I get from this account are being withdrawn out to cash for living expense spending. So far, this account doesn't grow too much because we withdraw pretty heavily, about 15% per month out of it. And then basically this 4,400 amount that we withdraw every month are being withdrawn the same across all the hypothetical portfolio to track how the same withdrawal strategy would work if I were to go with a different strategy like VFV, XEQT, HYLD, which is shown in the bottom over here. So the past month, the account dropped by maybe 60,000, which is quite a big drop. Um, but then let's compare it with other portfolio. But before that, I want to explain again why I sold a YMAG. Personally, prior to all the change that YMAG did, I consider YMAG one of the best income ticker that fit me really well personally. So YMAG originally was supposed to be, this is from the Purpose website, this is all official. YMAG was supposed to be about the top 8 tech company in the world, right? Alphabet, Tesla, Meta, Microsoft, Amazon, Apple, Nvidia, and Broadcom. And then they do basically do all these 8 ticker, and then they market cap weighted them, and then they do leverage 25% and sell cover call on top of it. They used to distribute about point 20 cents per month. So the yield was about like 14%, which is respectable, a little high, and then the expense ratio was actually pretty reasonable for what you get. I really like this ticker. However, recently they changed it to market like an equal weight random, like not random, sorry, like 15 tech stock equal weighted, same strategy, and then they raised the distribution by 10 cents, 50% to 30 cents. So now it used to be the best thing ever for me, and now it just becomes another HHIS, right? Which is nothing wrong with that. It's just not what I'm looking for. I want to be able to control my portion of the portfolio into crypto myself. I don't want to be having someone control that part for me, and I really prefer it to be market cap weighted. So now YMAG lost all the charm of what I like about YMAG, and now it become another HHIS clone. So I decided to sell all of them. As you can see here, I sold out of all the YMAG. I had about maybe 7,000 shares total, which is quite a hefty amount. I sold out all of them, and I switched them all to QQQY, which fit my need a little bit better. And then another thing is that they raised distribution very aggressively by 50%. So a lot of people like this, but personally, I don't want a crazy raise or crazy cut. I just want a good amount and then just raise a little, like a raise consistently over the period of time. Just do like a 10% raise per year to keep it consistent whilst you maintain a lot of a good price growth. So crazy raise like this, I understand that for marketing purposes, it draw a lot of new investor, but for me, I don't like it. So I sold out of it. Sad, but it is what it is. Just for reference, this is what it used to look like. So I used the Wayback Machine, go back, a year ago from, I think this is like August 2025. This is how it used to look like, right? Market cap weighted, and then just the top 8 company. I also really like that they really put out, they're really transparent about where their options are, like what's in the money, what's out of the money, etc., etc. Okay, anyways, so yeah, I sold out of that. This is what it looks like right now. Okay, so let's go to the hypothetical portfolio, which is the VFV. So VFV 2 years ago, I really thought that this would be the best performing, right? Everyone else always just be like VFV and chill, just buy VFV, forget about it, long term, really good. And so far it performed well. It just didn't perform as well as I thought it would. So how it is that this is the initial starting when I start tracking at end of 2024, and then I track all the withdrawal. So basically all these withdrawals are based on this amount right here. It fluctuates month to month, but basically whatever this portfolio pay, I match it the same across all the portfolio. And so far, since the beginning, we have sold 325 shares of VFV to fund our living expense. As you can see, as the price grow, sometimes our withdrawal also grows, so that's why all these amounts sold are fluctuating. How it works here is that I do a VFV dividends and I spread it out across 12 months. And then if there is slight discrepancy, I tend to round it up in favor of VFV, just to make that clear. Cash interest rate is 2.5%, so the cash also match up across our portfolio. So far, VFV have grown quite a bit, so now it's at $1.013 million. Okay, so let's go to next is XEQT. The XEQT has been definitely really, really popular lately, and then you can see why, right? XEQT, for those of you not aware, is a global diversified portfolio with the heavy in US and also a decent size in Canada. And if you follow the market, you know that Canada has been performing really well the past year or two because it has a good portion allocated to natural resources, and natural resources basically booming the past year. XUT now is number one, outperforming every portfolio that we have basically tracking. I originally thought that VFV due to heavy allocation in Canada might underperform US tech like QQC or VFV, but this have proven to be false so far. Again, the whole thing only been tracking for about 2 years, right? So you got to take everything with a grain of salt. In a long period of time, number could be very different. Because if you zoomed out, XEQT I believe still lose to VFV a little bit. So again, XEQT is a little bit harder to track. So basically, this is the sold and bought ratio. XEQT pay quality dividends, and sometimes the dividends is exceeding the amount withdraw. So as you can see here, I end up have to buy shares instead. So then I buy it back, and then I try to keep it as consistent and as accurate as possible. Of course, this is all done by hand, so there might be small mistake, but usually when there's discrepancy, again, I lean forward to give benefit to other hypothetical portfolio just to kind of, So basically, so this is XEQT and HYLD is the next one. This is actually a very popular among the income community. It's a very all-rounded US income ticker that also has a modest leverage of 25%. Originally, when I first tracked this one, my initial assumption is that HYLD is going to be the least, the worst performing. Not bad performing, but the least performance among all the portfolio. This has proven to be false. It actually outperformed VFV, which is quite surprising because cover call does cap upside, and but again with 25% leverage, I guess it does help a little bit. In combination of VFV was also sorry, the word escaped my mind. It's not currency hedges, and then US dollar has been dropping, I think 11% for the past year, so that does play in benefit of HYLD. If you track this as VSP, it might look a little bit different. But this is not to track which ticker perform what, right? It's more like to track a strategy. If I were to early retire using which portfolio, how it would have done. So HYLD, since they pay a very good distribution, it's a bit tricky to track. So basically, I slap a 7% capital gain tax on it, which is fairly low. And then after everything, every month, I basically have to buy more shares. So as you can see, HYLD share increase every month. And then so far, since start tracking, we have bought 5,324 shares. So the share is going to keep growing. And the more share you have, the more price growth, you're going to get the more benefit of that. So yeah, HYLD definitely performed a lot better than expected. And next is QQC. I recently added in, I think about 3 months ago, because I really want to see how it performed against NASDAQ. So basically, I have to retrofit all the number, but thankfully, because I post on Reddit and Blossom, so I can kind of go back and take a look at the numbers and try to match up properly. It did take some time. Again, QQC pay quarterly dividends, so the number here is a little bit kind of like sporadic, so bear with it here. So far, since the beginning, we have sold 1,500 shares to fund the living expense. QQC, when I added, I assumed that, because it's such a heavy tech, it would definitely perform the best, but again, it's still lacking behind XEQT, and thankfully, our main portfolio is outperforming QQC as well, which is quite surprising because, the more income allocation you have, usually it does create a drag on your return. But so far, it's been good. QQC definitely doing well because initially when we start tracking, the starting amount is about 932,000. Every portfolio actually grew a decent amount. All right, and then let's take a look at the side-by-side number. So as you can see here, we start tracking in the late 2024. We pull a trigger to retire, I think, around mid Q2 of 2024 to start living off income full time. I think at the time, our portfolio was starting at about 850. So now we are sitting at this amount right here. So this is the live amount, the latest one. We start tracking in 932, and you can see the growth and all the growth here. Okay, I recently add the cash holding. As you can see here, the cash holding kind of come down. I think we were kind of traveling that time, so the cash reserve was coming down. And then in April of 2020, and then I think we already back in Canada during this time. And then during the April, the Liberation Day, the market dipped really hard. So I decided to use a lot of the cash to kind of buy into the market during April. Turned out to be a really good decision. So when I buy something, I basically I add across the board the same amount, right? So if I buy something, I put 15K into main portfolio, I will put 15K into VFV, XQT, HYLD portfolio as well. And then we are in progress of building the cash back up. So this is the kind of like the graph. I like to see it visually, right? This is kind of look really beautiful to me. So this is the graph starting. You can see the big Liberation Day drop over here. a big drop off, and after that everything kind of been going up crazily. QQC and the main portfolio was kind of neck to neck until recently when the market started dropping. You can see that the nice thing with XEQT being the most diversified among across our portfolio is that it does help when the market drop. So you can see that XEQT barely had a dip here, and then everything else is kind of dropping a lot harder because it's a little bit more higher exposure, higher beta to, and then also higher exposure to tech. Having exposure to Canada and also the world definitely help XEQT outperform. So so far XEQT performing the best. So let's talk a little bit about this dip, right? Everyone been kind of saying like, oh my God, the crash is coming, all these things. But guys, let's be real here. It barely dropped, right? It only dropped like I think US maybe dropped like you know maybe tech only dropped 5% for the year, and then you can barely say it's a crash. It's only been 2 weeks. So I mean, if you think this is a crash, then then I don't think you're ready for a real crash, right? Because the real crash is going to be a lot more painful than this. Um, if 2023 happen again, it's going to be a big grind down, and I expect all the tech to, be probably going to be shaving 25% of the portfolio, and then you better be ready for that because it's going to be quite painful. I wasn't retired during that time in 2023, but it was definitely painful. You get grind down every day, just keep going lower because interest rates just keep going up and up. Um, I mean, there's a saying, don't fight the Fed for a reason, right? Because that's why interest rate plays such a big part. But again, when there's misery, there's also opportunity. So it's good to keep an eye out for opportunity. Um, some people ask me if a drop happened, what am I gonna do? Would I be anxious and upset? I think because my withdrawal rate is so low, right? We're only sitting at a 5 to 6%. I think it'll be okay. And the thing that gave me confidence to pull the trigger early is that our expenses are very flexible. Like, sure, I might be spending 4K now, but I can really cut back and spend a lot less during bad times and try to put more money into the market. I think the key to having this early retirement and a little more unconventional, without having tens of millions of dollars or like a few millions to kind of withdraw from, is that you have to be flexible. Me and my wife, we live a very tame, very boring life, you per se, but we're really happy with what we live, how we live. So that allows us to be more flexible with our budget. So I think that really helps when the bad time comes. So let's take a look at a little bit of a question on Reddit. Actually, let's go over this first. So I did a little bit of like a visual over here. So month to month, it did drop 75K, which is quite a big amount, 6%. So definitely for month to month here, we did underperform VFV and QQC. So this is the amount drop with or without the distribution included. 2025, we did return 16% and 21% with if you include the withdrawal. 2026 so far we're down 6%, which is quite a bit more compared to VFV and QQC. Despite having a decent fixed income portion, I guess the betas is still quite high due to the tech exposure of the portfolio. 2026 goal, I'm still working on this. We're just going to continue eBay listing. This I used to work in retail, so we do have a lot of stuff that I want to offload slowly. Have to rebuild the emergency fund back to 30,000. I try to have a full year worth of emergency fund set up just in case bad time come. I don't want to have to pull out of the market so much and try to reinvest the rest. Okay, so basically I usually post on Reddit and Blossom first before I post the video form. Some gentleman here has a good question here, so I thought I would go over with everyone. So usually when I post on Reddit, it's a little bit difficult to try to make it not so wordy, so sometimes it come off unclear. So he's asking margin minus 174 interest for 1 month. Yes, so basically he think he's referring to this portion over here. So basically this is based on a margin balance. So it shows that I'm taking out 38,000 and per year we did this much and this much. So total net margin, this is the amount that I project to get per month, average per month after the margin and everything. Again, the margin balance is not accurate right now because I do sold some put and then a lot of them is kind of margin pending. So technically I only minus 24,000 in margin, but I do have put obligation that I have to buy the stock if the price go under a certain amount. Okay. Second question, is this done with Smith maneuver? So Smith maneuver, I believe, is if you take out home equity. No, this is basically just a portfolio margin, not a Smith maneuver. I mean, I'll be open to it, but I don't want to deal with a lot of extra headaches, so I'm not doing that right now. Why utilize only 12% of the margin account? Do you have calculation made for risk? Show anything higher than that mean something that would be an issue? No. The thing is, I'm open to using more margin, but I'm gonna use it when I see opportunity, right? Because basically, this margin account is a little bit more like active. I don't want to say trading, just more like active option selling when I see a good opportunity. I don't want to have to force to maximize my margin every month. Again, the goal is not to generate 30-40% return. The goal is to generate extra 1 or 2% return per year. If it's more, it's great, but I'm not going to push it. So again, 12% is what it is right now. I'm open to using more. Okay. Living expense one sold to cash out or are they dividend? So living expense again, this amount is basically withdraw every month for living expense. Why everything under register account? Why is everything under unregistered account? So basically, this portion here is register account between me and my wife. Okay. Only XQT would have beaten your strategy. Where did you get those up one number form? So far, XEQT outperformed all the portfolio. The number again, I just went over it. So oops, sorry, this is like a hypothetical. Okay, so basically the numbers are starting here, tracking the same withdrawal and tracking the same growth. I guess I went over this already, so I'm not gonna go over that again. Overall, your investment growing or you liquidating it for expense. So in the main portfolio, I'm not liquidating anything. I'm just living off the living expense portion of the portfolio. So far, everything has grown nicely, not just the main portfolio, but every portfolio altogether. Okay. Um, yeah, so if you have any questions, please post in the comment. Um, if you think the questions is, interesting, then I'll kind of like showcase it in the call in the video over here as well. And yeah, so that's basically the February update of the Canon income portfolio, sustain and early retirement. So hopefully I'm doing well. Again, for life update wise, I'm been really busy because if you follow my journey, you know that my mom is going through some health issues. So we've been going to a lot of doctor's appointment to make sure that, if you deal with cancer patient before, you know that there's so many appointments you have to go to, or the blood work every week, sometimes 2 times a week. And then I'm just glad that me and my wife, we have this opportunity to be there for her and then drive her to appointment and be there when she needs it, when she need help. It's it make you don't it make you not take anything for granted, right? My mom's is we like an immigrant family. We moved from Asia when I was quite a bit younger. She basically a workaholic. She worked her whole life, and she's about to be retired. I mean, she enjoyed working, so she pushed her retirement to traditional retirement age. And right when she about to retire, she got hit with the cancer. So it's again, I hammer this point down every video that you can't take things for granted. You got to enjoy your journey. You can't just be like, I'm gonna work really hard for 30 years and just bet it all and enjoy it at the end. I think it's important to enjoy it along the way with people you love, people you care about. And yeah, that's it for this video. Thank you for watching. Hit like and subscribe if you want to see more. And I'll see you guys next time. See ya.